Hello investors, happy to connect with you once again. I think as we meet, we are sitting at a very important time in global history. The entire global economic order is being reshaped. You've seen that several erstwhile strong economies are now struggling for their place in the global economy. But on the other side, there are economies like India, they are very eager to capture that vacant slot. So I think if you think of longer term macro for India, I don't think it's been as good as it is today for a while. But while we are thinking of longer term positives, we should not get too complacent because from a very near term point of view, there are several macro uncertainties. Most of them are global in nature, and I think you know most of them. Chinese economy is slowing down. Europe is potentially staring at an energy crisis in the winters. In the US, the Fed has made it very clear that they are going to raise rates till they tame inflation, even if that comes at the cost of economic slowdown. So I think in this context where the entire global economy or a large part of it is going to slow down, it's unlikely that India will stay completely unaffected. Yes, we may do better on a relative basis, but on an absolute basis, I think we should also brace for some challenging macro as we go along. And this is happening at a time when valuations aren't particularly cheap. For us, the most preferred way of looking at market valuations is to look at equity valuations in conjunction with bond yields. So if you think of the PE that Nifty or the Sensex trades at today versus the 10-year GSEC, which is at 7.4%, then valuations are pretty expensive. So this combination is very interesting. You're looking at a situation where the long term is as promising as it has ever been, yet there are near-term global uncertainties which are likely to impact the local economy as well. And then valuations are a bit on the expensive side. So I think it's fairly, from a conservative point of view, it's fairly prudent to say that the next few months are going to be challenging. But I think, what as investors we should do is to not get swayed too much by market moves on either side. I think we've seen that over the past 12 months. On an end-on-end basis, we've largely seen a flat market, but within that flat market, we've seen sharp moves both on the way up and way down, and investors have gotten emotional on both sides. So I think there's a good chance that this volatility will persist in the near future, but we should stick to our disciplined investing, to our asset allocation. And the most interesting part about the past 12 months has been that this correction has meant that the overall market sentiment, which was very euphoric 12 months ago, has now turned more neutral. So the entire market was very frothy 12 months ago, but now thanks to the correction of the past 12 months, there are pockets which are now presenting opportunities, and it's those pockets that we are trying to exploit in our portfolios. So I think both the portfolios follow an approach where we are very bottom up in our stock selection, but at the same time we are macro aware as well. So what that means, keep this macro context in mind when selecting stocks. But just to play a macro theme, we will never get or will never compromise on the rigor of bottom up stock selection. And I think it's this combination that so far helped both the portfolios to be in good shape, and they've weathered the market storm relatively well. And we hope that that will continue in the future as well. And at the end, just want to say that thank you so much for your continued trust in us. And our process-oriented approach to investing does give us confidence that we will continue to deliver on your expectations going forward as well. Thank you.